Welcome very much to session one. We're focusing, as you know, on the AER revenue proposal. And we have a number of speakers for you today. So my name is Amanda Newbury and I'll be facilitating today. And we have a number of other presenters who will be joining you. You will know many of those presenters, I'm sure. So our first presenter is Jennifer Harris. She's just over here to the left of the screen. Her official title is Group Manager for Network Regulation. Our second presenter is Lutfia Alamanli, who's over here at the front, and she is Stream Leader for Opex. Our third presenter is Greg Hesse at the front. He's Stream Leader for Capex. And our final speaker is Paul Reynolds, who's at the table towards the back, and he's Stream Leader for Finance. We also have Tina Patrick, who's at the back of the room, who'll be facilitating. And I'll quickly step you through how we're going to run the session. Don't get too comfortable because you will get to move a fair bit. The key point is that we want, as much as possible, to be able to hear from you. And so we've got 20 minutes allocated at the start for some presentations. We are assuming that you've done the pre-reading. I know, don't laugh too loudly, but I'm sure you will have done the pre-reading. But we'll also, and you'll see, we'll do that for about 20 minutes. We'll leave questions if we can towards the end because it'll give you the full picture of the revenue proposal. But actually, you might want to take those questions to the round tables. So we're running 3 round tables. One on CapEx, one on Opex, and one of the rate of return. I'll explain how that will work, but you won't have to stick on one. We actually want you to move across and contribute to the range of tables, and we'll help you to do that in a way that's easy. At the end, we're going to look for themes from each of those round tables to try to make sense of what we've heard. And then Jennifer will take that back to the larger room so that the other 2 groups, understand what was said. As you know, the videos will be available, but also a report on what's been heard in each of those sessions. So the full details will be available later, but we want to come back at least to the larger room and explain what happened in each of the rooms. I'm going to hand over to Jennifer Harris. She's going to talk through the process thus far, as well as the key dates and the other opportunities for contribution going forward.
All right, can you hear me? I'm pretty loud, so I probably don't really need this at all. My name is Jennifer Harris. I'm the Group Manager Network Regulation. So I am fortunate enough to look after 3 key areas of Powerlink's network regulation activities. The first one, of course, is Powerlink's revenue reset process. The second one is annual transmission pricing. And the third one is all other market-related matters. So, yep, I've got the full trio with me. Today, I'm here just to give you a heads up on where we are with our revenue reset process. So Powerlink has commenced preparations for its revenue proposal for the next regulatory period, which we have out from 17-18 out to 21-22. We have reached 2 key milestones in the formal revenue reset process. Prior to June 2015, we have had consultation with the AER, and AER has undertaken consultation with stakeholders on its framework and approach process. So the AER has published its final framework and approach paper in June 15, Now, for those of you who may not be familiar with that paper or that process, what that paper does is it sets out how the AER will actually apply certain things to our revenue proposal and the next regulatory period. So it sets out its approach to things like the incentive schemes, the expenditure forecast assessment guidelines, and also depreciation. The second key milestone that we've hit in our process is that at the end of June, we lodged our expenditure forecasting methodologies with the AER. And those methodologies actually set out the methods or the basis by which we will forecast our Capex and Opex expenditure in our revenue proposal. In front of you, and for those of you who did your homework last night, we also prepared and submitted one-page overview documents of those methodologies, and we tried to make them more consumer-friendly, but truth be told, we're actually using those documents internally within Powerlink for people who are not directly on our revenue reset team. So it's like a quick reference guide for you. Our next key milestone is January 2016, when we are required to lodge our revenue proposal. I don't need to go through all the rest. The AER is expected to release its final decision for us at the end of April 2017, and our new reg period starts 1 July 2017. Thank you, Tina. So what are we going to do between now and January next year when we lodge our revenue proposal? We're here today, this is an engagement opportunity for you, and we're here to outline other opportunities where you can provide input and feedback. In the first presentation this morning, Merrin mentioned that we have commenced a customer and consumer panel. This is a Powerlink business as usual panel, and we have 2 meetings scheduled, one in August and one in November. Our first panel meeting was in May, and as it coincided with preparations for our revenue proposal, our first panel meeting was about the revenue reset, and we'll discuss that a bit more here today. So that panel there's about 17 members. We've tried to get a cross-section of our customers, consumer groups, distributors and other stakeholders, and we do have an independent chair for that panel. If you are interested in what goes on at those meetings, the agenda, the minutes and any pre-reading material as well as the slides that are used are published on our website, so feel free to go and have a look. Other engagement opportunities, you'll notice I've put a tentative forum up there. We actually expect between September and October to want to consult on other things. For those of you who have been involved in a revenue proposal process, as you're working through your preparation material, there's often things that come up and you think, well, I would really like to get somebody else's view on this instead of my own and my own company's. So what we may actually do is put information on the website and send a notification to people who have registered at that email address to say, look, we want to talk about this. It's only come up recently. A forum may occur in the next 2 or 3 weeks. If you're interested, please let us know as soon as possible, and first come, first serve. Obviously, I don't think we have the facility to put on a forum for 150 people, and neither do we think 150 people might actually want to participate in something that may be a matter of detail. So please register your interest with that. There's also the opportunity as a result of today or on an ongoing basis, if you have any burning issue you want to raise in relation to our revenue proposal or the process, please feel free to send us an email at that address there. I'm looking forward to our discussion today, and I'll hand over to our next speaker. Thank you.
Good morning, all. My name is Lütfiye Alamanli. I am Opex Revenue Stream Leader. This morning, I will talk about our Opex forecasting methodology, and at the end, I will seek your input to our methodology by asking some questions. Powerlink will follow the approach AER EFA guideline sets out, which means that we will apply base step trend methodology, which is the methodology AER prefers to use when they assess TNSP's OPEX proposal. 14-15 is our base year. Under base step trend approach, the first step is really identifying the base year. So base year 14-15 is third year of our 5-year regulatory period. Typically, AER uses third or fourth year of 5-year regulatory period as being base year as efficient year. Base year represents ongoing recurrent expenditure. Therefore, any non-recurrent or one-off costs should be removed from the base year expenditure line items. Once we establish base year as efficient, then we will apply annual rate of change to our controllable cost. Rate of change is calculated by 3 input parameters, which are output change, real price change, and productivity change. Then we will add or subtract any other costs that are not captured in the base year or under rate of change calculation that require forecast. These costs are non-controllable costs or any step changes to forecast our future OPEX. This table sets out AER's EFA guidelines, which really highlights base year should be recurrent and efficient to provide reliable and safe transmission services, which is really consistent with national electricity objectives. To be consistent with that, what we are doing is we analyze historical and current regulatory period trends and compare those results with future forecasts. We also consider RIN data, RIN information, and other benchmarks, and then compare them with future expenditure. And additionally, if required, we will be having detailed engineering review to demonstrate that our base year is efficient and represents for forecasting our future OPEX. Currently, we are establishing our base year, and this forum is really great opportunity for us because we are interested in to get your input, your thoughts, your comments, your views, your questions into this methodology that will help us to form our base year and our forecast for OPEX future. Thank you.
Thanks, everyone. My name is Greg Hesse. I'm the Reset Stream Leader for Capital Expenditure. This presentation is a high-level summary of a lot of the detail that's contained in our forecasting methodology that was submitted to the AER on the 30th of June this year. That methodology is available on the Powerlink website. In our methodology, we've described how we're forecasting, we're intending to forecast capital expenditure into the next period as a hybrid, a mix of more detailed bottom-up project-by-project forecasts to meet future investment needs, as well as elements of top-down forecasting based on predictive modelling around asset reinvestment decisions, as well as trend analysis for some aspects. Combination of those two arriving at our forecast capital expenditure requirements into the next regulatory period. Feel this is a fit-for-purpose approach as opposed to TNSPs have often done full bottom-up project-by-project analysis for every last dollar in their capital expenditure. We've been cognisant of the expenditure forecasting assessment guidelines the AER has published and how they intend to assess CapEx forecasting. We're certainly of the view that this hybrid methodology can provide all the information the AER needs to apply its assessment techniques under that EFA guideline. So we feel this is a fit-for-purpose approach that could actually be a lot more accessible for stakeholders in understanding how we've arrived at forecast capital expenditure. Another view of how this looks. There's a diagram also from our forecasting methodology document. What this is representing a continual process of how Powerlink makes investment decisions, capital investment decisions. So in terms of a proportion of total capital expenditure, at any point in time moving forward, elements of forecast capital expenditure are represented by projects that are already approved, underway, committed for implementation. So that's that larger blue area there. Even as we speak today, there are approved projects underway in Powerlink for which capital expenditure will be extending into the next regulatory period, out into 2018, 19, 2020 sort of years. The next step along the process is, even before we get to a project approval, there's a lot of work done having confirmed the need for an investment, a condition assessment that says, as Stuart said, a transmission line has reached the end of its useful life. What are we going to do with it now in terms of replacing, retiring, reconfiguring, etc. During this process, options are being investigated, high-level estimates are being prepared, options analysis, and that's that sort of red area there. So things are not yet approved, but they're underway, on the way to being an approved project. The balance is then, okay, we've got a forecast need, we expect we'll need to spend capital expenditure, and that's a mix of bottom-up and top-down approaches out there. The blue triangles are what we're proposing to put forward as indicative of future investment needs, so people can get some sense of, well, if we're talking about spending $40 million on secondary systems replacements at some period in time, what might that look like? So some indicative future investment needs, and that's particularly what we're wanting people's input on today as to what criteria we might adopt in bringing up those indicative future investment needs for more supplementary bottom-up analysis. Oh, yeah. Whoop. Okay. To summarise all that in table form, as I said, for projects and investments that are already approved across any category, whether it's driven by changes in demand or reinvestment needs or support the business IT, the sorts of things, if they're approved, they've already got detailed bottom-up analysis, so individual project estimates, business cases, board approvals, management approvals as required. We're still talking about 4 elements that might be driven by changes in demand, and there are a couple, not many, we're expecting. They would still be done on a more detailed bottom-up basis. Once we come to what we call our non-load driven, which is our reinvestments, certainly a mix of top-down and bottom-up type approaches. We've taken on board feedback we've received from stakeholders, including the AER. For instance, as a particular class, power transformers, they're large, high-value, relatively small number in the fleet of our assets. So we've recognised we need to forecast any reinvestments in transformers on a bottom-up basis. But in a fleet of 20,000 plus transmission towers of varying ages, we feel it's more appropriate to be forecasting those reinvestment needs on a more top-down basis. But as I said, from those blue triangles, we will be providing additional supplementary information in support of that. For some of our other categories, again, security compliance and other, a mix of top-down and some bottom-up supplementary information where there are specific unusual or large investment needs that have been identified. We'd be providing additional bottom-up information. So as I said, We've already discussed this model with our customer and consumer panel. Wait, thank you. So we've got some initial feedback from them on this question about what criteria we might adopt in those blue triangles, those indicative future investment needs. We'll have that as a starting basis on our CapEx methodology table when we start the breakout sessions from here. And we'd be really welcoming your input as to what sort of criteria could we adopt in selecting those indicative projects. So just heads up on the question. Okay, I think it's Paul.
Good morning, everyone. My name's Paul Reynolds, and I'm the stream lead for the finance part of the revenue process. This morning we want to have a conversation with you on the weighted average cost of capital and Powerlink's approach to developing this. For those of you who are perhaps like me and don't do your pre-reading before we come, let me just take you through what the weighted average cost of capital is and a little bit of a brief background. So to start off with, it's the average cost that a business incurs to finance its asset base, or in our case, the regulated asset base. It consists of a mixture of funding options, both debt and equity. And typically when businesses look to put this mix together, they consider a number of options that are impacting on their business. Ultimately though, they're looking to optimise the cost of their debt and equity mix, so that to achieve a good outcome for the business that doesn't only just focus on the cost, but also focuses on giving some flexibility to meet its ongoing needs over time. So when we have a look through the guidelines, the AR provided this optimal mix for us in the terms that they is considered to be a ratio that considers 60% debt and 40% equity to provide this optimal mix. The revenue, once it's determined, of that, around about 60 to 70% of the revenue in the determination comes from the application of the WACC to the regulatory asset base. Powerlink is in the early stages of its development of its WACC proposal, but what we have decided what we are going to do is actually follow the AER guidelines as they're set out. The WACC is, as we put this together, we won't be able to have a view of the final WACC until very late in the process, because it does rely on a lot of market conditions and changes in market rates as we go. So it won't be actually formalised until April 2017 as part of the final revenue determination process. In taking this approach to determining the WACC, there are a couple of challenges which we do face, and this applies to understanding how some of the determinations or some of the ranges have been determined when it relies on some level of judgment in putting it together. For example, the beta. It's unclear in some aspects how the range from 0.4 to 0.7 was determined when relying on the primary evidence that was used to come to that determination. Having put the range together, then how the final range of 0.7 was adopted is also relying on some level of judgment on the evidence presented. The market risk premium is another area where we see this being applied, and makes it a little bit challenging to be able to adopt the same approach. For example, there's two models used for the weighted to come up with the market risk premium: the historic excess returns and the dividend discount model. These come together to create a single range, and then there's a point estimate derived from that, which is 6.5. There is some level of judgment and in coming up with both the range and therefore the point estimate in that. And so these are just some of the challenges which we face as we go forward. The ongoing application of the WACC once it's set, in historic previously the regulations, once the WACC was set, that was it. It was set for the period of the regulatory period. The change that has come about more recently is that the WACC will change year on year. It will be reset to reflect the 1/10 of the Powerlink's changing debt requirements, and therefore reflecting the changing in market conditions from a debt perspective. So what we will see through the process, through the regulatory period, the WACC will change. I thought it would be interesting just to have a look at what historically has happened with regards to WACC levels over the last few years. On this chart, we've identified more recent determinations, those that have been finalised and those that are in draft form still, and tried to represent where those determinations come from. So on the chart here, the green line that we have here, that represents the average of all of the network service providers that we've identified on the chart, their previous average WACC returns. And there's a range of around about 8.3 to about 10% overall. The red line on the chart is Powerlink's current WACC of 8.61, and the blue bars represent both the finalised determinations for a lot of the representatives on that chart and a couple of the draft ones at the end there. You can see what the chart is really showing is that the WACC has reduced significantly over time. It's dropped between 2 to 3% over that period. So we are seeing the rates come down significantly. So as I said, this is an opportunity to open up discussion and have a chat to you about your thoughts on the determination and specifically in this case determining the WACC. And one of the questions I thought I would like to start to get some feedback on are there any elements you would like Powerlink to have regard to when formulating its WACC submission? So thank you for your attention, and I look forward to having a discussion with you shortly.